Iceland's default in 2008 was one of the most notable events in global financial history, caused by a crisis that affected not only the country, but also a number of international financial institutions. During this period, three of Iceland's largest banks, Kaupthing, Landsbanki and Glitnir, went bankrupt, leading to economic collapse and significant social consequences for the country's population. Iceland was experiencing rapid economic growth in the early 2000s. The country was attracting foreign investment and the banking system was expanding rapidly. During this time, the Icelandic government implemented a series of reforms to liberalize the financial sector, which led to aggressive lending and risky investments by banks. Kaupthing Bank, for example, significantly increased its assets by borrowing heavily in international markets. By the end of 2007, the Icelandic economy began to show signs of overheating. Rising house prices and consumer credit were worsening, and the country's foreign exchange reserves began to shrink. Nevertheless, the underlying structural problems went unnoticed, and many experts did not predict an imminent crisis. With the global financial crisis beginning in 2007 to 2008, the situation in Iceland worsened. In September 2008, the collapse of the investment bank Lehman Brothers was the catalyst for a wider financial panic. Icelandic banks, which were heavily dependent on international lending, began to face liquidity shortages. At this time, the Icelandic government and central bank failed to provide the necessary measures to support the banking system. By October 6, 2008, the scale of the problem became apparent. Kaupthing, the country's largest bank, was unable to obtain funding and declared bankruptcy. This event set off a chain of events that led to the complete collapse of the banking system. Default and its aftermath. On October 3, 2008, the Icelandic government announced temporary measures to nationalize Landsbanki and Glitnir. However, these measures proved insufficient. Shortly thereafter, the government defaulted on its domestic debts, which came as a shock to international creditors. The financial crisis in Iceland led to a sharp depreciation of the Icelandic krona, which caused hyperinflation and exacerbated economic problems. Unemployment began to rise and living standards plummeted. In 2009, unemployment reached 10%, and many Icelanders lost their savings. The crisis also sparked massive protests among the population, demanding accountability from the government and banks. The protests led to the resignation of then Prime Minister Geir Haarde and his government in early 2009. International assistance and reconstruction. In response to the crisis, Iceland turned to international organizations for help. In 2008, the International Monetary Fund, or IMF, provided the country with a loan of about $2.1 billion. In addition, Iceland also received financial assistance from other countries, including Norway and Sweden. In 2011, Iceland began an economic recovery program aimed at stabilizing the economy and restoring confidence in the financial system. A key step was the creation of a new banking system that was less dependent on international markets and focused on domestic lending. Measures to control inflation and improve fiscal discipline were also introduced. As a result of these measures, the Icelandic economy began to gradually recover. By 2014, the unemployment rate had fallen to 5%, and the economy showed positive growth. Iceland was also able to restore its reputation in the international arena and return to the financial markets. Conclusion. Iceland's default in 2008 was an important lesson for many countries on how insufficient control over the financial sector and dependence on international loans can lead to disastrous consequences. Despite the hard times, Iceland was able to recover and is now considered a success story in recovering from the crisis due to timely reforms and support from international organizations. In summary, Iceland's experience demonstrates the importance of financial stability, transparency, and the need for resilient economic structures that can withstand external shocks.